Okay, let's dive right into this explainer. Today, we're putting the absolute giant of snacking, Mondelēz International, through the ultimate fundamental analysis gauntlet. Because honestly, there's no better way to see what's actually under the hood of a massive blue chip stock than testing it against the best valuation frameworks in the world. Here is our agenda. We'll look at a quick company snapshot, then view the stock through the lenses of three absolute legends: Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run some modern DCF models, and finally, synthesize the whole thing into a clear, actionable verdict. Section 1. Company Snapshot, the contender. Let's meet the heavyweight we're analyzing today. So, Mondelēz International, ticker MDLZ, is hovering right around $58.83 a share, boosting a massive $75 billion market cap. Ever since they spun off from Kraft back in 2012, they have literally dominated the global snack aisle. I mean, look at this breakdown. Nearly 48% of their revenue comes from biscuits and roughly 33% from chocolate. Basically, when you buy Mondelēz, you are investing in the entire world's sweet tooth. And looking at their first quarter 2026 performance, they brought in over $10 billion in revenue. That's a solid 3% organic growth rate. Plus, they reaffirmed a staggering $3 billion in expected free cash flow for the year. Now, it wasn't all perfect. They did take a hit from soaring cocoa costs, which dragged adjusted EPS down to 67 cents for the quarter. But even with that headwind, their global snacking growth is just incredibly durable. Section 2. The Buffett Lens, Moat and Management. Let's see how they measure up to the Oracle of Omaha. You know, Warren Buffett absolutely loves a brand monopoly, and Mondelēz has an economic moat built entirely out of iconic household names. We're talking Oreo, Cadbury, Toblerone, Ritz. This kind of portfolio gives them immense pricing power, which is absolutely crucial when input costs, like that crazy volatile cocoa market right now, start creeping up. So going through Buffett's qualitative checklist, they honestly pass with flying colors. Do they have an economic moat? Yes, for sure, backed by a really impressive 6.3% growth in emerging markets. Is their debt manageable? Absolutely. They've got about $375 million in interest expense, which is easily covered by over $1.1 billion in operating income. Add in high returns on equity and that expected $3 billion in owner earnings, and it's a very strong setup. But, and this is a big but, even Buffett demands a margin of safety. You need that discount between what the stock is actually worth and its current market price. At nearly $59 a share, that margin is basically non-existent. Buffett, the value investor, would likely sit on his hands and wait for a pullback into the low 50s before he'd even think about buying in. Section 3, the Lens, Categories and Growth. Let's figure out what kind of story this company is actually telling. Peter Lynch would look at Mondelēz and instantly slap a stalwart label on it. They aren't some scrappy, fast grower. They are a massive, ultra-reliable machine currently guiding for 0 to 2% organic revenue growth. You buy a stalwart for downside protection when the market gets rocky and for those steady dividends. You definitely don't buy it expecting the stock to double overnight. To figure out if a stalwart is priced right, Lynch leans heavily on the PEG ratio. That's the price-to-earnings ratio divided by the EPS growth rate. Ideally, he wants to see that ratio below 1.0, which basically means you're getting a great deal on the growth you're paying for. So let's run the numbers. Based on their annualized Q1 earnings, the PE ratio is sitting up around 21.9 times. Now, if we take the upper end of their 2026 EPS guidance, growth tops out at roughly 5%. That pushes our estimated PEG ratio all the way up to 4.38. Since our source data doesn't show any huge insider buying to offset that premium, Lynch's framework would definitely rate this a solid hold. You're just paying a pretty big premium for that stability right now. Section 4, the Graham Lens, Deep Value Mathematics. Time to strip away the feel-good brand story and run the cold, hard numbers. Benjamin Graham's defensive investor checklist is ruthless. Let's see how they do. Adequate size? Pass. A $74.8 billion market cap is plenty big. Strong financials and earning stability? Pass. Dividend record? Yup, they just returned $600 million to shareholders in Q1 alone. But when we look for moderate price-to-earnings and price-to-book ratios, the stock's current premium valuation completely fails Graham's strict rules. And that brings us to Graham's famous intrinsic value formula. It's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. This is basically the ultimate conservative math test.
Since the exact book value isn't explicitly detailed in the earnings excerpt, we have to make an educated assumption here. If we take an annualized EPS of $2.68 and estimate a pretty standard industry book value per share of $21.50, the formula spits out an intrinsic value of just about $36. That means Graham wouldn't even touch this at $58. For the father of value investing, there is zero margin of safety here.
Section 5. DCF Valuation and Alternative Models. Let's step into the modern Wall Street era. Okay, here's how we're building the discounted cash flow model based on the data. For step 1, our base cash flow is that solid $3 billion they guided for 2026. Step 2, we forecast that out 5 years. For step 3, the transcript doesn't hand us a specific weighted average cost of capital, so we're assuming a standard 7.5% WAC. In step 4, we use a 2% terminal growth rate, which perfectly reflects their mature, steady nature. Now, this sensitivity table is super revealing. If we flex the cost of capital and terminal growth rates, you can see how much the valuation shifts. Under our base case assumptions, that 7.5% WACC and 2% terminal growth, the DCF lands on a fair value right around $52 per share. Just to be thorough, let's run a couple of alternative models too. If we use a comparable PE analysis, assuming a standard 18 to 20 times multiple for this specific sector, we get between $48 and $53. And if we apply a dividend discount model, which rewards their super consistent shareholder returns, we get a very similar result. Across the board, these models tightly cluster the fair value between $48 and $55. Section 6. Synthesis and Final Verdict. Let's bring all these legendary frameworks together. Synthesizing everything we've looked at, Mondelēz is clearly a fantastic business, but it's trading at a premium. Buffett's framework points to a $52 fair value, meaning wait for a pullback. Lynch sees a stalwart with a high peg, rating it a hold. Graham's deep value math targets $36, which is a hard avoid. And our DCF models suggest a fair value of $48 to $55. Basically, every single model suggests the actual intrinsic value is slightly below today's $58 market price. So, here are your key takeaways. The strengths are undeniable, right? 40% of revenue comes from high-growth emerging markets, they have an unbeatable, inflation-resistant brand moat, and they churn out $3 billion in free cash flow. But the risks are real too, mostly around those cocoa input costs and potential pushback from consumers over package downsizing. My final verdict? It's a solid hold. Across almost all these frameworks, the buy trigger really sits down near $50. I'll leave you with this provocative thought to ponder as we wrap up this explainer. In a volatile economy, is the safety of the world's best snack brands worth paying a premium? When inflation really starts to bite, is overpaying slightly for an unbeatable economic moat actually the safest bet you can make? Think about it. Thanks for joining me on this deep dive into Mondelēz International. Keep learning and keep analyzing.